All right, good morning, everyone, and welcome to our Equity Explorer webinar. I'm Karena, a Global Equity Investment Specialist at Fairtree, and I'll be moderating today's discussion. So just to give you some insights on what Equity Explorer is, basically this series was designed as a teach-in on topical subjects in the equity markets. And what we are trying to do is just provide deeper insights into key industries, companies, and trends shaping global investments. So yeah, our goal is to equip you with knowledge to better understand the forces driving markets and uncover opportunities within them. However, please do note that this isn't financial advice, nor is it a deep dive into our portfolios. So moving on from that, I am excited to announce today's topic, which is on the rapidly evolving world of public cloud computing. So in this session, we'll explore key trends that are shaping the industry, and we'll focus on the leading providers, mainly being Microsoft Azure and Amazon AWS. While Christoff is presenting, please feel free to send through all questions. We'll try to answer as many as possible at the end. With that, I'd like to hand over to Christoff, who will take us into today's deep dive on the public cloud industry. Christoff, over to you.
Hello, everyone on the call. I'm excited to present today for you. So, as Karena said, my name is Christoff, and I'm an analyst on the DM as well as the EM Global Funds. So just looking at the setup for the presentation today, we're going to start with really the basics, going through the introduction of the public cloud. We're going to discuss some of the definitions and terms. Then in the second part, we're going to talk a bit more from the enterprise shift, which has been driving demand probably from around 2013. It really started. So this was when computing started to go from on-premise to in the cloud. Then lastly, the most topical probably is the AI revolution that is currently happening, and then we'll end with some Q&A. Okay, so let's kick it off. For those on the calls that might not know, so predominantly the US is the big three hyperscalers. So that is AWS, which is owned by Amazon, Microsoft Azure, that is owned by Microsoft, and then Google Cloud, which is owned by Alphabet, which is Google's parent company. Per definition, Meta is also described as a hyperscaler, but the only difference is they use their computing demand to service just their own services, whilst these companies sell their computing demand to enterprises on the outside. So just looking at the revenue for these three players, it's actually been such a growth industry. So in 2019, the combined revenue growth, or the combined revenues rather, of the three was just over 50 billion. At 4x until 2024, where it's currently over 200 billion. If you're just looking on the right-hand side of the hyperscalers, AWS is the largest. So they currently have around 50% market share, but they have been ceding market share through the years to some of the smaller players, which is Azure and Google Cloud, which combined also have around a 50% market share. So when looking at a new industry, I just like to actually go through the timetable of all the building blocks, the developments that happened to get to where we are now. So just looking at cloud computing, its origins are already in 1961. So those who might not know, John McAfee is a very smart computer scientist. So he was one of the founders actually of the disciplines of AI. And he already in 1961 started to theorizing about computing as a utility, basically, as a concept. And what that means is that he saw in the future that he thought that you can buy computing power, computing resources, similar to what you buy like your electricity at from a utility company. In 1969, then ARPANET was created, which is basically the first public network. This was actually joint venture between the Department of Defense and universities in the US. In 1995, the term cloud computing was trademarked by Netcentric. In 1997, Salesforce launches the first SaaS model. So SaaS stands for software as a service, and we'll discuss it just in the next slide, but that's one of the building blocks of the public cloud providers. In 2006, AWS launches externally, which is quite interesting about this AWS launch is, so one of the main products that they sell or forms the foundation of their offering, it's called Elastic Cloud Compute. But that was actually created by two South Africans called Chris Pinkman and William van Biljon. Then in 2009, Microsoft launches Azure. So for those who are actually quite familiar with the Microsoft investment case, might know that Azure is one of the main growth drivers for the company going forward. But this was actually created in the Steve Ballmer era and not in the Satya Nadella, which probably a lot of value is ascribed to him. And then in 2012, Google launches Google Cloud. Now we're starting to enter the AI phase of public cloud. So in 2017, Google Research introduces the transformer architecture, which this basically forms the foundation of all the large language models that are being used today. In 2022, ChatGPT went viral, reaching 1 million users in 5 days. And then lastly, is basically from 23 to where we are now, is this massive data center build out to support future AI demand. So I thought by just starting with two definitions to make sure that everyone is just on the same page. So what is cloud computing? Cloud computing is very basic. It's just the delivering of computing services through the internet. Definition two that I just want to touch on is what is a hyperscaler. So a hyperscaler is a company that provides cloud computing services just at a massive scale, leveraging global distributed data centers. Then just shifting to the right-hand side of the slide. So as you think about cloud computing or public cloud services, there's three building blocks towards it. So infrastructure, which forms the foundational layer of public cloud. That's basically, so infrastructure as a service is a cloud service that provides businesses with on-demand access to computer resources. Then just moving up the stack to platform or platform as a service is a cloud service that provides developers with tools and environments to build, run, and manage applications without worrying about the underlying infrastructure. And then lastly, software or software as a service, that's probably the one that we're most familiar with, is just as a cloud service that delivers ready-to-use software over the internet. So just making it a bit more practical and going through some of the examples of what all of these building blocks comprise of, just starting with infrastructure. So infrastructure, as I said, again, the foundational layer is compute, which is CPUs, GPUs, RAM, including storage or networking. So just on the second one, or the middle one, platform. So as I said in the previous slide, platform as a service provides tools and environments through the cloud to build, deploy, and run applications on the internet. A key example of this compute and app hosting, a key example of this is compute and app hosting. Let's say your enterprise develop its own application and you publish it online. Depending on the user demand, you may need to use more or less infrastructure at different times. A service like Google App Engine or Azure App Services automatically scales the app based on the required demand from the infrastructure that you need. And then just lastly, software as a service. This is a lot of examples like Microsoft Office, Google Workspace, Microsoft Defender, but also some of the HR or SAP-like programs that you use on a daily basis that's provided through the internet. So you might be wondering, how do I choose a cloud provider? Because infrastructure is largely a commoditized service. And that is correct. If you buy a GPU from Azure, you buy a GPU from, or usage of a GPU from Google Cloud, it's all a commodity. But there are different ways that these guys have positioned themselves. So as you can expect, Microsoft, who has a very strong footing at enterprises and Fortune 500 companies, have used that to basically further gain traction with larger enterprises. So you'd see them actually having significant share in platform as a service. Then just looking at AWS. So AWS, when it started, really positioned itself in Silicon Valley. There's even a lot of articles where they gave out free compute credits to some of the startups. So you still see today that a lot of startups use AWS, and their client set is slightly skewed to a startup type enterprise. In the next slide, I just want to go through how a typical data center looks in 2024. So a data center is such a homogeneous term, and we think of it as just like one thing. But in a data center, there's servers, but there's also stuff like generators to provide backup power. And then lastly, there's also a lot of like cooling towers, because data centers tend to work at a lower temperature a lot better. That being said, still 80% of your cost of a data center can be attributed to IT equipment, so IT equipment being the server rack. So that's a major part of the cost driver currently of a data center. I thought it'd be interesting just to do like a small case study of how does it scale and how these next generation of data centers look. So just on the left-hand side, that picture I have is the XAI Memphis data center. So those who might not be familiar, XAI is Elon Musk's artificial intelligence company. So the reason why I'm using them, it's currently rumored to be the largest training cluster of GPUs. So it's rumored to have 200,000 of GPUs, and they've stated recently that they want to increase it at some point to 1 million. But just using that 200,000 of GPUs, just putting that in context. So 200,000 GPUs at the AI cluster versions at least, use around 700 watts of power. So just the GPUs alone use 140 megawatts. So generally there is a rule of thumb. So if you for data centers, total power usage to be 2 to 2.5 times that of the GPUs. So speculations are currently that this data center alone uses or requires 200 megawatt to 280 megawatts just to power the data center. Because they can't get so much electricity just from the local utility, they're currently using 14 mobile generators as well as Tesla megapacks to power to support this huge power consumption. Now, for those who, including myself, actually sometimes, megawatts don't actually mean that much. Just to put that in context. So currently for a small city of 100,000 people, you require 100 megawatts. On average. So for a data center, which was between 200 and 300 megawatts, that's a small city of 200 to 300,000 people, which is obviously a huge amount. And then just most of these next generation data centers are skewed to the US. They're mainly built they're mainly built in the US market. So now starting that we've covered, I think, some of the basics, let's start with the first driver that I want to talk to, and that's just the enterprise shift. So where does the public cloud fit in the enterprise? So most of you might be familiar with the left-hand side picture. So I actually think of my IT lab at school also, where the server rack basically sat in the room and you constantly heard this low-level drone or noise actually going on. But this is basically how workloads tended to work a few years ago. It's probably, some of you might still use this kind of setup where the server rack basically sits in the office. Where this is shifting towards, and this is the enterprise shift for public cloud compute, is that customers A, B, C, whether company A, B, and C, they connect through the internet to a data center to basically save, storage, and manage all of their work. So this is where we are heading, and this is where we have been heading in the last 10 years. For those who are still unsure, maybe where the public cloud fit in, if they actually use the public cloud, I just thought I'd use this example that we use currently cloud-based applications on a daily basis. So just for instance, Netflix, the app that we all use to stream all our favorite shows, use AWS mostly as the background, was the infrastructure to supply all these movies and series to all of us. Spotify, their main cloud provider is Google Cloud. TikTok in the US specifically uses Oracle Cloud. And then lastly, LinkedIn uses Microsoft Azure. So it's currently estimated around 30% of enterprise workloads are currently run in the cloud. So there's still a huge amount of workloads that are still currently run on premise, 70%. There's some reasons why certain companies will never shift, but I think there's still a strong runway actually for this to continue into the future. And the reason why I'm saying this is if we look at the advantages and disadvantages of using the public cloud. So one of the main advantages of currently using the public cloud is just scalability. So what is scalability? You only need to pay for the resources that you basically need using the public cloud. If your business grows, it's not a problem. The cloud operator can just accommodate that growth. And if your business shrinks, that's also not a problem. You can just decrease your usage and just pay less. The second part I wanted to touch on is rapid deployment. So no longer do you need to get an IT engineer or a server engineer just to come to your office and install a server rack. You can be tomorrow on the cloud using AWS services if you want to. Third point is maintenance free. Because all the maintenance is done offsite by the cloud providers, you don't have to need an internal team. And then lastly, global reach and accessibility. So for instance, I currently sit in the UK. It's not a problem for me to access the Fairtree work or storage that's saved because of everything is done in the cloud. So automatically you have a global reach and accessibility. That's all good and well, but what are the disadvantages then? One of the main disadvantages I think companies speak a lot about is vendor lock-in. So what does that mean? So once you are an AWS customer and you start growing as a company, you tend to have to stay an AWS customer. You can have a multi-cloud environment, but you tend to stay one. And the reason for that is it's very expensive to switch from cloud providers, and it's very expensive to get your data back on an on-premise setting. So it needs to be actually a very thoughtful decision that you make. Then the second point, rapid cost escalation. Due to the rapid deployment, when costs can just rapidly go up, or you can scale the business rapidly up, rapid cost escalation is also a problem if it's not something that is monitored by the firm very closely. I put in here latency, but I don't think for most clients this is a problem. It's just if you need really high-speed access to data, you tend to have your data center in-house versus outside of the city or outside of Joburg or Cape Town, which is a few kilometers out, but for most people that should not be a problem. And then lastly, security concerns. There hasn't been major cloud breaches. The reason why I just reference security concerns, so in certain industries like, let's say banking, international banks especially like to own their own customer data and save their own customer data on premise as an additional security feature. So that's an industry, for instance, that will never shift probably fully on the cloud. So that's why I also said in the previous slide, it's currently at 30%. It's likely to increase, but it's never probably going to be 100% of enterprise workloads. So we're currently going through this CapEx cycle that everyone's probably seen in the news, but this is not the first CapEx build out or major CapEx build out that these public cloud companies have gone through. So I've just currently showed you here the history of the capital expenditure growth, the year-on-year capital expenditure growth for Microsoft versus its revenue growth. So when this cloud momentum or this enterprise shift started to really take, or before it, started to having momentum rather, Microsoft already started to build out huge amounts of CapEx or data centers, predominantly in the 2013s or early 2010s. And you can just see the CapEx increased by a lot, but this was not traditionally met quite quickly with revenue growth. And the reason for that is these data centers tend to have 12 to 15 months or 12 to 18 months, depending on the labor, whether you can find to build this, but there tends to be a lead time before you can really build them. And then after you build them, they take some time to scale. But as you can see, Microsoft went from around 10% growth business to when this enterprise shift started to around 15%, with Azure starting to really drive that reacceleration in the revenue growth. So on the left-hand side, which is quite interesting, so the orange line is just Microsoft share price, and then the gray area at the back is Microsoft share price over the S&P 500 index. When this increases, the share price of Microsoft obviously outperformed that of the S&P 500. But you can see when the build out starts, the market was very slow to react to this asset that is going to generate revenue or revenue re-acceleration in the future. And only when they started to see that revenue re-acceleration and close to the 28 period that Microsoft really started to outperform the market. And that ties into the right-hand side graph. This is just Microsoft return on asset. So as you can see, okay, let's just quickly define return on asset. That's just basically your income over your average asset base. So you can see in 2013 or the early 2010s rather, as they started to build up this data center asset, their return on the asset actually went down. And when they started to generate revenue, this started to scale, and this coincided with the share price outperforming. So where we are now currently, and what the market is currently debating on, is this massive data center AI build out that we're currently having, and whether this is going to scale or not. So this high initial fixed cost period and then combined with a period to scale is not necessarily unique for the Microsoft Azure business model. This was similarly experienced by Google Cloud and AWS, as they also took some time basically to scale. AWS was obviously the first mover, so they had a longer time. But as you can just see, Google Cloud basically came in 2019 from minus 50% margins to just over 10% business in the recent financial year. And the reason why they've been able to scale so nicely is just because of the extremely strong revenue growth. I'm going to use Google Cloud specifically as an example. As you can see from 2019, this business basically grew ahead of 40%, and it's currently growing at 30% rates. Okay, so now that we've covered the enterprise shift, I want to talk about the next shift, basically, of the public cloud or the hyperscalers, which has been this AI revolution. So some of you might be slightly familiar with this, but for those who might not know, all of the hyperscalers tend to have an agreement or their own AI model, LLM model. So with Microsoft, Azure took the approach where they invested in OpenAI, and you have access to ChatGPT's model that's on Azure. For Google Cloud, they internally developed their own LLM models, which is called Gemini. And then lastly, AWS developed Amazon Nova. It's also worth just mentioning that Google Cloud, as well as Amazon, invested in Anthropic, and they currently run the cloud or Claude models basically from their own data centers. So this is just an index of basically an intelligence score for all of the LLM models. So a higher score tends to mean a better model. But I wanted to show you just the first takeaway that I want to show from this chart is there's currently a huge amount of LLM models in the industry. And then secondly, the ChatGPT models tend to be slightly or always scored a little bit higher. In second place, we actually had the Grok model, which is XAI, Elon Musk company's models, which are also reckoned currently to be some of the best models. That being said, due to the fact that we're going through this extreme exponential investing curve, the positions of these graphs are far from stagnant or stationary. All of these companies invest a lot, and based on releases, you would see maybe a Gemini model being a bit higher up the 1 month, and then a ChatGPT being a bit lower. But one thing that's great for the fact and for the industry that there's so many models currently competing and being trained is cost to inference. So what inference basically means is basically just the cost to run these models. And as you can see, I got this chart just from Andreas Horitson, from A16. And basically just what it shows is the cost to run basically per million tokens and for a certain level of model. So on the blue line is for a ChatGPT type model. So as you can see, in the 2022 period, it cost around $60 to generate basically 1 million tokens. But that over the period of time, and due to the competition and innovation that we've just seen has gone to basically cents. And the same is for ChatGPT 4-like model. So initially it was also close to 60 models to generate 1 million tokens, but that price has just come down a lot actually in the last few years. And why this is important is this is actually quite foundational as you think about it for the adoption of the models. If you're going to build main applications that are going to be used by a lot of companies based on AI services, the cost of this basically needs to come down. If I can just use an analogy to further explain this, when you're currently working with an Excel spreadsheet and you're dragging down a formula, you don't think about the compute costs going in that to generate every row of data. And probably the same is going to be in the next 20 or 30 years. When you use an AI-based application, you're not going to think or worry about the cost of inference to generate output of that model. So that being said, there has been a huge amount of CapEx spend for these models or because of these models. As you just can see, I've just summarized here Microsoft, Alphabet, and Amazon's CapEx since 2018 till 2025 financial year. So they've guided for this. And as you can see, just from 2023, they spend just above 100 billion, and that is expected to increase to over 250 billion. On the CapEx growth side, most of the CapEx is currently expected to grow between 40 and 20%. This is significantly ahead of revenue growth for these groups and has led to CapEx as a percentage of revenue increase significantly. So for Microsoft, for instance, this was a plus 10%, between 10 and 50% CapEx as a percentage of revenue company. And now it's going to be between 25 and 30%, which is a huge amount of reinvestment that is being spent into the business. And just to emphasize currently on this slide is why the companies are spending this CapEx. And there's two main components to it. The first part is just being able to build the leading AI models, or being able to build a model that can have or fulfill the necessary use cases, potentially for companies to adopt. And then the second part of it is serving the leading models, which is driving a lot of the CapEx currently. So these companies are building data centers currently all over the world to be able to serve future AI demand as uptake by these companies start in the future. To serve these demand, actually, again, tying back to the slide that I just had, and 3 slides back, basically, was the cost to training, or cost for inferencing these models have come down. And hyperscalers are spending a lot also to bring that cost down. But one way they've been doing this is by investing a lot in their own GPUs, or their own ASICs, rather, as they call it, as application-specific chips. So my colleague Ashen in our previously Equity Explorer presentation just showed how the hyperscalers are investing a lot in the NVIDIA GPUs, which is just shown in this graph, the huge amount of CapEx that has just gone to NVIDIA's GPUs to basically serve and build out these data centers. To kind of bring that cost down and decrease the dependency, we've seen AWS, Microsoft Azure, and Google Cloud invest in their own chips to basically bring down that cost. So for AWS, we have Trainium and Inferentia, which is application-specific AI chips. And the second part is Microsoft Azure, which is invested in Maya, and then Google Cloud, which is probably ahead of the curve with this, which already on their 5th generation of chip. They're investing a lot in TPUs. So what do we know from the hyperscalers actually of the revenue that they're generating from the AI models? So not actually a lot. So the only company that discloses data on that is Microsoft Azure. So they've split out the Azure growth that's coming from AI services and versus which is coming from the core Azure enterprise revenue. And as you can see, in the latest quarter, it was around 15% of the revenue from that specific segment. So if you annualize it, it's just over 10 billion. So 10 billion is not a huge amount considering that they're spending 80 billion, But what is more important is the growth trajectory of this Azure services that predominantly will pick up due to the fact that the new next generation of data centers are continually scaling and being finished because they're obviously being built currently. And just breaking down the Azure growth that the business experienced. So in the latest quarter, Azure just grew just under 30%, or 28%, and around 50% of that growth was coming from Azure AI. So if you stack that, around 30% for the 13% for the whole segment was generated from Azure AI services. So as you can look at the cloud growth for all of these companies in the last few quarters, as I stated, the build out mainly started in the 2022-2023 period, and we have started to see some re-acceleration of growth. It's also worth mentioning that these companies are growing at extremely high rates, between 30 and 20% year on year, which is very impressive considering that this industry as a whole is close to 200 billion. Also, what you might be wondering in your back is how are these companies funding these huge amount of data center build-outs? So different to the dot-com bubble in the 2000s, where a lot of the telcos were levered to be able to support the build-out of the fiber networks, with this current build-out, these companies are basically paying it out of their free cash flow. So as you can see on the left-hand side, I have the net income, which is the orange bar. On the right-hand side, I have the free cash flow of the companies. And as you can see, this difference between net income and free cash flow has increased in the recent years due to the companies having to spend huge amounts of capex. But again, all of this is funded internally with their own cash rather than debt, as we have seen, which is actually quite different than what we have seen out of previous IT cycles. And these are the last two slides. I want to currently just show that we are starting to see some increase or some evidence that revenue is going to come for these companies due to the capex build out, and that just through their backlogs that have been growing ahead of revenue growth. So most of these companies, all of these companies have reported significant backlog growth. As a combined total, they've experienced, or they currently reported, a 500 billion market cap that will flow through to revenue in the next 3 to 4 years. So I just did an interesting exercise, just considering how much capex changed in the 2022 to the latest financial period, and that's the black bars, basically just the difference in that, in comparison to the backlog that was added in that same period. It's not a perfect analysis. There's a lot of question marks still in this. Backlogs are normally also cancelable, but at least you can see that there's been a significant more backlog basically added, or more revenue that is going to flow through from the groups in comparison to the capex that was added during this period. But thank you very much, everyone, for the time. That was all my slides. I think we're going to go now to Q&A.
Amazing. Thank you, Christoff. That was really, really interesting. I think we can spend the next 10 minutes or so on Q&A. So if anyone has any further questions, please send them through. But yeah, let's kick off with some questions. Maybe we can start just on, maybe you can give us some examples of real world applications of AI and what that looks like in the actual real world moving forward.
Okay, so currently, as you think about AI models that are currently being run, they're very good at deterministic tasks. So what I mean by that is tasks that you can see if the answer is correct or not. So a lot of this is being used in math and programming currently, because if you can clearly see if it runs of a program or with coding, if it's wrong or not, due to just the deterministic nature of it. As we go forward, we haven't actually seen major agentic type of applications that have been written or with AI, but that is probably where we are going forward. If I can just use the analogy, when the internet came out, nobody necessarily thought of an Uber-based application that is going to come, and it's probably similar to AI. Probably similar to the AI cycle. We still need to see a lot of the next gen software being written and stuff like that.
Great, thank you. So maybe we can move on. Obviously, this has been topical in the last few weeks. Could you just elaborate on what the impact of DeepSeek has been on the hyperscalers and sort of your understanding of what it could be moving forward?
I personally see DeepSeek as as actually a very good thing for the hyperscalers. So let's just talk about DeepSeek firstly. DeepSeek wasn't created in a vacuum, right? So DeepSeek used very smart techniques such as distillation from ChatGPT models to basically create their models. So that was the first point how DeepSeek was created. The second part of it, they used also quite smart techniques like a mixture of experts to bring down the cost of inference. So to bring that down, that cost, those techniques are probably going to be applied by the other AI models currently in the industry. So it's going to bring down the cost of inference for the whole industry. That being said, with the cost being down for the whole industry, that should drive adoption because that's mainly the hurdle currently for companies to apply it on just a team basis versus a whole enterprise basis is cost. So I think DeepSeek net in the long term should probably be a positive because it brings down cost of the industry, which should increase adoption, which is obviously a major benefit for the hyperscalers.
Great, yeah, that's really, really interesting, and we'll be excited to see how that unfolds in the next few years. Just moving on to another question that we've gotten here. So if the compute offering from the hyperscalers are considered a commodity, do they have a competitive advantage, and what would it be per se?
That is a good question. So as I stated previously, the hyperscalers serve a commodity service on the enterprise side. But the main moat that they have and why other companies struggle to compete is just the fact that they're hyperscalers, that they do it at such a big size, which is very difficult for smaller companies to be able to compete against. So just the size and the sheer scale of these hyperscalers is basically the main moat to their business.
Cool, thank you. I've got a couple questions here on CapEx, so I'm just going to try and put them all together. So maybe just to start off, do you see Arista Networks as a key beneficiary of hyperscaler growth? And then are there concerns about hyperscalers cutting back on their CapEx, or even potentially them developing in-house solutions instead of outsourcing?
Okay, so for those who don't know, Arista is a provider of switching networks predominantly to the hyperscalers. So their main two customers, I believe, is Microsoft and Meta. So they have a very big exposure to those companies. And the company has benefited a lot with the CapEx growth going forward. There is a few bit intricacies to that. So I'm not going to go now. I'll just refer back to email to the person who asked this question. But there is a bit of intricacies to that question because Arista still has a lot of penetration within the data centers. I think that they can get potentially from NVIDIA, who currently sell full stack solutions that include InfiniBand and their own Ethernet switches. So there's a bit of intricacies to that specific question, but I'll rather refer that back to email to the person who asked that.
Great, yeah, I think that's a good idea. So maybe we can just move on. Another question that we've got is about tariffs. So basically, we're trying to understand what impact do the US tariffs have on the data center build out and the materials required. We're just trying to understand if it'll become more expensive and more free cash flow negative, or will the company sort of moderate their CapEx spend to offset some of those costs?
I think for the tariffs, just currently the environment is so changing. I was this last week at conferences and the tariff question comes up continuously. And it's just interesting to see all of the management of the companies, which is obviously the closest to their spending. Nobody knows. There's no certainty because it changes everything so on a day-to-day basis, which is being covered. All that being said, as I showed in the previous slide, around 80% of their CapEx are being around the data center build out cost, around 80% of that is related to IT server equipment. So predominantly being NVIDIA chips, if we just break it down. And NVIDIA chips are being produced in Taiwan. So we've recently seen news, I think in this week, from TSMC agreeing to build around, I think, 100 billion of data centers, of the data centers fabs to construct these chips in the US. And that's predominantly a way to make sure that Taiwan doesn't give any tariffs in the future. So it's something that we constantly monitor because it's such a changing environment and it's hard to make definitive statements. But currently for them, most of their cost is coming from GPUs. I don't think that should be a problem.
Cool, great, thank you. I think it is quite a, like you say, uncertain environment. So also looking forward to see what happens in the next few months. And then maybe just lastly, before we end the session, we can talk about regulation a bit. So a question we've gotten is basically around the fact that AI is not well governed at the moment. And some of these companies are using inputs from businesses and individuals to build their LLMs. This obviously to create faster and smarter models. Just in your opinion, do you think their growth, the growth of the AI offering will slow down when there are more regulations put in place? Or do you think it'll just be further adoption and see further growth?
So I think this question is predominantly going on the training side, because there has been a lot of reports where some of these models use copyrighted material to basically train them to generate better output. That is probably going to be very topical. Again, this is an environment that's probably going to change regarding laws about what these models can be trained on. But for the current phase, that being said, so that can probably change, and that will change in the phase as we're going forward. But for where we were coming from basically the last 2 years, I remember when I said ChatGPT only went viral in 2022, I think an environment that doesn't have a lot of regulatory constraints was actually best for these models because you saw this rapid growth, them being able to just improve the whole time. And you can make the comparison between Europe, the America approach, where America has a fairly unregulated approach, where Europe has a more closed, regulated approach, setting a lot of rules. Just the advantages of model development that was done in America versus Europe, I think that is very telling. But going forward, there will probably be new regulations coming forth. But we don't also know what the use cases of these models are going to be. So it's difficult to regulate something that you don't know how it's going to be implemented also in the future. So I expect more regulation. Sorry, in conclusion, I expect more regulation to come, probably around copyright and business IP. Other than that, we might actually see as a second order effect from this is that people start to move a lot of their more secure data or data that not secure data, but data that they see part of their IP off from the internet, which is kind of a second order thing to kind of create this data moat. But that's probably something in the long term that we'll see how it plays out.
Amazing. Thank you, Christoff. I think we will call it there. If there are any further questions or if anyone in the audience would like to continue the conversation, please feel free to reach out to myself or anyone at Fairtree and we'll be happy to assist. But yeah, just on that, Christoff, thank you very much for your time and the presentation. It was super insightful. And yeah, to the audience, we look forward to seeing you on the 10th of April, where we will be discussing US home builders. Yeah, have a great day and thank you very much.
Thank you very much, everyone. Have a good day.